You're watching the second quarter update to Russell's 2015 Global Outlook. I'm Mark Supasay. I'm here in our Seattle studio today with Andrew Pease, our Global Head of Investment Strategy. Andrew, thanks for being with me today.
Pleasure, Mark.
I appreciate you taking just a few minutes to recap the outlook and sort of where we are now 3 months into the year. Let's start there. One of the things that you focused on was the expectation that divergent central bank policies likely would play a big role in what we would see in capital markets. How's that played out here 3 months into the year?
That has been a big theme so far this year. We're seeing it already. The European Central Bank has launched an enormous quantitative easing program. It's looking more and more likely that the Bank of Japan is going to extend their quantitative easing program in the next few months. And at the same time, we've seen a range of central banks across the emerging economies ease interest rates, plus speculations increasing that the Fed will start its tightening program within the next few months.
So let's look at 3 additional points that were in the outlook that I thought were of particular importance for investors. The first is the expectation that we would see single-digit profit growth continue. The second being that you expected a likely gradual decrease in unemployment rates. And third, a gradual tightening on the part of the U.S. Federal Reserve in terms of monetary policy. Have we seen those things come to play?
We have. They're still very much on track. The U.S. reporting season we've just been through is very much pointing the line of single-digit earnings growth. We are seeing the labour market continue to tighten. The unemployment rate has fallen quite a bit. Our model is telling us that we'll see 230,000 jobs per month created from here on in. If that's right, that will get the unemployment rate down to around about 5% by the end of the year. And that tightening labour market, even though it hasn't translated into wage and inflation pressures yet, certainly will over the next few months, I would expect. And if that's the case, the Fed is very much on track to start their tightening program. We think probably around about the September.
Okay. So as the name implies, the Global Outlook looks at regions around the world. Here as we enter the second quarter, can you touch on some of the high points from each region? What should investors be particularly maybe concerned about, and where are the reasons for optimism as well?
Okay, so the high point really is Europe right now. Okay. That's been our highest conviction call for a while, and it's starting to come through. So particularly European equity exposure, we think, is where there's still some more upside to come. We've got the quantitative easing happening. Credit growth is picking up. Austerity is eased off. Europe is a big beneficiary of a big fall in energy prices that we've had so far this year. So Europe is looking like a place where there's more upside and the valuations are still reasonably attractive. So we do like Europe. Much more neutral on the United States because of those high valuations, and a little bit more cautious on emerging markets, even though they are still quite cheap.
Okay. Let's shift gears then and look at asset classes before we wrap up. Let's take 3 specific areas: real assets, emerging markets, and currency. Any shift in sentiment here as we go into the second quarter in regards to those asset classes?
Not really. In terms of currency, last year we put out the theme that we found it very hard to be bearish to the US dollar. That would still be the case, even though the US dollar has probably now moved into more outright expensive territory, given the big gains it's had against both the yen and against the euro. But it's very hard with the Fed likely to be tightening and those other central banks expanding their quantitative easing programs to move against that view right now. Real assets are a bit of a wash. Commodities have been negative. We don't see that turning around anytime soon. But in terms of REITs and listed infrastructure, we're pretty much market weight neutral on those asset classes right now. And on emerging markets, we're still quite cautious. We think they're cheap, but the combination of the rising US dollar, falling commodity prices, the slowdown in China that's still unfolding, and what we're seeing is a heightened amount of political risk across a lot of these economies just keeps us a little bit cautious about something which is still a good long-term opportunity, but on a shorter-term horizon, we're still a little cautious on emerging markets exposure.
All right, good stuff. So to wrap up then, let's talk about focal points for the remainder of the year. Where should investors be paying attention as we go through the remainder of 2015?
Well, the one where they have to be focused the most for the risks is in the US market, and particularly looking at those average hourly earnings numbers and waiting to see when does that falling unemployment rate turn into higher wage pressures, which means higher inflation pressures, which means downside pressure on profit margins, which would be consistent with rising long-term interest rates and falling profit margins. We think it's going to be a gradual process, but if there's one risk indicator to watch for, it will be a rapid rise in average hourly earnings if that was to happen. So that's the downside risk. The upside opportunity to keep an eye on is still Europe. A lot of people have bought into this and a lot of people may be thinking of taking profits, but we think it may be a re-rating opportunity in Europe. There are a lot of positive things happening. We're not super optimistic about growth. We're not expecting much more than 1 to 1.5% GDP growth, but we do think there is good potential for double-digit profits growth in that market, and that is something that investors should not lose sight of.
All right. Andrew, as always, thank you for your time and your insights. We appreciate them, and we appreciate you joining us here on this second quarter update to the 2015 Global Outlook. We'll see you next time.